Welcome back to another episode of Asset TV's View from the Floor. I'm Jillian Kemmerer, today joined by Ruth Yang, who is the Global Head of Private Market Analytics at S&P Global Ratings. Ruth, great to have you and congratulations on the new role.
Thank you, Jillian, and thank you for having me today. I'm very excited to have this conversation.
And it's a great time to be having this conversation, right? Because we've seen an explosion of growth and interest in private markets and private credit specifically. So maybe you can tell us a little bit about how that market is sizing up and what's driving the growth.
Yeah, it's a really interesting time. I think, first of all, private credit has been around for a long time, but it has rapidly grown and evolved really over the last decade. Where we see it right now is that it is basically on the same size as the high yield bond in the loan market. Each one is about $1.5 trillion, which is very impressive. Historically, it was created in order to really fund small to medium-sized enterprises, SME transactions, but where it has come over the last decade is to be a really integral part of funding larger and larger borrowers. When we look at it, the growth is really driven by low interest rate environments, the rise of private equity, and investors hunt for yields. But this market is here to stay, and it's going to be an important part of how you raise debt capital in the future.
Now, inevitably, with any uptick in interest in an asset class, there's always questions about things like opacity, and that's something that's generally been tied to private markets. So I'm wondering how, in your role in S&P Global Ratings, you really help to improve the transparency around private markets and private credit.
Yeah, it's definitely famous, or maybe a little infamous, for its lack of transparency and its high levels of opacity. So within S&P Global in general, right, our aim is to provide clarity and transparency on the market. Our insights on the asset classes are very important. We provide benchmarks to really highlight the risks and the opportunities within the market. And of course, we have best-in-class data. We approach this market from a number of different perspectives. Within ratings, our clarity and transparency really comes from our assessments of the creditworthiness of borrowers. And this is what we do. We provide insights and clarity on the creditworthiness of both public and private borrowers. And then within this private market space, we have public ratings, we have private ratings, and we have credit estimates. And not only do we have the ratings, all of our research and insights looks at a lot of deep dive information. We look at credit metrics on borrowers. We look at the default and performance of those borrowers and those ratings classes, of course. And then we also have market level trends on what's going on in the area. And it covers a number of different types of investments. BDCs, business development corps, which in the US are retail funds, middle market CLOs, and other types of investment vehicles. So we are very much present there to provide information from a number of different perspectives.
I'd love to talk a little bit of the research done on your credit estimate side. So recently the team performed a scenario analysis on 2,000 credit estimated issuers. What were some of the high-level takeaways from that?
Yeah, so let's clarify first what credit estimates are. Credit estimates are a point-in-time assessment of the creditworthiness of a borrower. These are by and far largely private borrowers, and we see these credit estimates and we're able to assess them through the lens of our middle market CLOs. So we actually have about 2,400 credit estimates, and they do really tie to the direct lending SME side of the market. And what we do is we do two things, one of which we provide quarterly updates on how those credits are performing and how those smaller companies are performing. And then in addition, we did recently do a stress test on 2,000 of the credit estimates. And what we found was, we looked at this and we said, okay, we're going to continue to stress them with higher interest rates for the next 18 months. And what we found was, though performance declined and that we saw that margins were thinning, we didn't see a massive uptick in default. So there is a resilience to these credits over time. The challenge really remains as we look ahead how long these high interest rate environments will happen. I think the other thing we want to bear in mind is borrowers have not fully ingested the impact of the higher interest rate environment that we're still transitioning to. Even if rates were to stop rising this year and they will start to taper down this year, we know that it will still take borrowers the better part of this year to fully absorb the impact of that. So we just remain a little thoughtful about we are not quite at the end of the transition to higher for longer.
And I think all of this speaks to a really important point, which is that it's not just credit fundamentals that paint the picture of what's going on in the credit universe. We also have to look at things like the global economy and the outlook there, geopolitical risk. So starting on the macro front, what are some of the factors you're keeping an eye on?
Well, higher for longer really is a really important part of where the market is right now. We constantly reinforce this. Our economists within ratings forecast that we will be experiencing a soft land in the economy, right? And our forecast also looks for rates to start dropping in the second half of this year. But as I said, the challenge really is that borrowers have yet to fully absorb the impact of higher for longer. In the best case scenario, right, if all of this comes together, we think that default rates will still continue to tick up slightly. They have been kind of trickling in along the way, but we do expect that the market continues to be resilient. We are also concerned about the growing maturity wall. One of the things we talk a lot about is the challenge of, in the next 2 years, all of this credit that's outstanding in the public and private markets is going to have to refinance out of this maturity wall. And in a higher for longer environment, that's going to be a difficult scenario for a lot of these borrowers.
And any further issues revolving around the market dynamics and how those are evolving, how might that impact the credit sphere in the next 18 to 24 months?
I think with private credit, there's been a lot of talk about competition between the public and the private markets. So as we look at the maturation and the growth of private credit over the last decade, I think that the lens that we look at it is it's now a third funding option for the markets. When you look at the bond market, the loan market, and now the private credit market, they all have very different characteristics, right? Bonds are highly liquid, highly transparent. They are also fixed rate. They're relatively expensive to fundraise for. It's a very complicated process. When you look at broadly syndicated loans, they are less transparent and less liquid, but they are far more transparent and liquid than private credit. They're floating rate. They have the ability to fund very large amounts, but they are, again, more complicated. It's a longer funding process. Private credit is the least transparent, it's the least liquid, but it is committed capital. The speed with which arrangers can fund these deals is very, very fast. They're able to customize the type of debt to the need at hand. If you're junior secured, senior secured, hybrid, there's a lot of different funding structures. They can respond to the needs of the borrowers. So I think when we look at this, we think that it is not really a competition, though there is clearly competition between public and private markets, but that what we hope is that it provides a choice for borrowers to think about what the right funding structure is for them going forward.
Ruth, it is such a great time to be having this conversation. Thank you for taking the opportunity to educate our audience and share what you're looking for and what S&P Global Ratings can do to help investors make better decisions.
Thank you, Jillian, for having me.
And thank you for tuning in. From our studio at the New York Stock Exchange, this was View from the Floor.